Editor-in-Chief of the Small Cap Informer Stock Newsletter. Welcome to our 2026 Outlook webinar for subscribers of the newsletter, where we'll take a look at the trends pushing the market in 2025 and consider what might be ahead in 2026. There is a questions tab that you can enter your questions in the GoToWebinar application, and I'll do my best to address those. And there's also a handout of the slides from this presentation that you can download, as well as our top small cap stocks for 2026 subscriber exclusive report. So look for those in the handouts tab. They'll be available when we archive the webinar as well. Let's start out by taking a look at the Small Cap Informer newsletter performance update for the 2025 year. A few notes: the target benchmark of our newsletter is the Small Cap 600 index from S&P. This is managed similarly to the S&P 500. So the companies in the Small Cap 600 are profitable and tend to be smaller than those in the Russell 2000 index. Some of the companies in the Russell 2000 are not profitable, and many of them are way outside our size definition for small company stocks. All of our Small Cap Informer buy and sell recommendations and dividends are tracked and then benchmarked to the S&P Small Cap 600 ETF. The ticker for that is IJR, and we use that for convenience of tracking the performance of the picks. Now, the resulting rate of returns reflect the entirety of the Small Cap Informer coverage over time, and since subscribers will not likely be buying all covered stocks, each individual's results will vary. But I'm pleased to report that in 2025, the Small Cap Informer picks trounced the S&P 600. The benchmark return, compound annual rate of return for the Small Cap Informer picks, was 17.2% compared to 4.7% for the S&P Small Cap 600. On this slide, you can also see the 3, 5, and 10-year results, where we continued to outperform in each of those periods the underlying index. But importantly, we also edged out the S&P 500 in 2025, 17.2% compared to 17.0%. This is something that the newsletter has accomplished only once or twice in the last 15 years. But we're very pleased that in this year, when small caps underran the large caps in the S&P 500, that our picks were able to exceed both of those indexes. We think that's a pretty impressive accomplishment. Our lifetime performance remains strong. Our total return on an annualized basis from 2012 is 8.4% compared to 4.1%. So double the returns of the small cap index. Now, with small caps underrunning large caps for most of this 14-year period, it's not surprising that these rates of return are relatively small, but still having doubled the rate of return of the index is a quite favorable result. So we're very pleased with that performance of our overall picks. Looking back now at the stock market performance in 2005 to see what the trends were, what was driving performance of the market, both for large caps and for small caps. This is a graph of the performance of the three segments of the market that I like to track: the EFA, Europe, Australia, Far East index in magenta at the top. This is the index that tracks large cap stocks in the industrialized portion of the world, so it does not include emerging markets, and it turned in a rare outperformance of 27.45% for the year. The EFA index has been underrunning the domestic US indexes for a number of years now, but they really jumped ahead in 2025. The S&P 500 turned in a 16.65% rate of return, and the S&P Small Cap 600 led from behind with 4.53%. So this has been the trend of the last few years. If we look at the small cap in particular, the gains that were eked out by those smaller companies were driven by a few things. One, the interest rate cuts certainly helped profitable smaller companies capitalize on the cheaper available credit. Tariffs and trade policy boosted interest in those more domestically focused companies, companies as many American businesses were looking to uh, find suppliers in the United States. Many small companies were able to step up and satisfy those demands. Small semiconductor companies also benefited from the AI buildup. It's not just the large caps semiconductor companies that were able to benefit from the interest in artificial intelligence, but many small semiconductor related stocks also performed well. The merger and acquisition activity also grew in the year. Many small companies became attractive targets. We had 3 companies covered in the small cap informer that were acquired in the year, and that's a trend that we'll look to continue in 2026. Now, there will still remain that significant valuation gap between large and small stocks. So some small cap investors pulled money out of the large cap and placed it in smaller company stocks, but that gap still remains, and so there's plenty of opportunity left in 2026 and beyond. And then in terms of consumer investor sentiment, many investors are still considering mega caps as safe havens when you can invest in the Magnificent Seven, and it always goes up. So the thinking goes, why would you worry about diversifying? And that is one of the lessons that seasoned investors know, that we can't count on the trend of large caps and mega caps to continue forever, which is why it's important to diversify into mid-sized and smaller company stocks. The mega cap influence continued in 2025. If you look at the S&P 500 rate of return in orange at the top compared to the S&P 500 equal rate return in blue on the bottom, you can see the Magnificent Seven and the other mega cap stocks in the market weighted S&P 500 index continued to deliver results that were greater than the average of the other 493 companies in the S&P 500. And so that influence of mega cap stocks continues over time. Of course, if we look at the long-term track record, this is going back to 2001, we can see that small caps retain their leadership position over the long term, while followed by the S&P 500 large cap US stocks, and then the EFA at the bottom. Despite its returns in 2025, still trails over the longer period. But if you look at the graph, you can see there were periods when each of these 3 sectors took the lead and the others followed behind. Those trends are important to keep in context as we enter 2026, when especially small cap investors are wondering, is this going to be the year when small caps pull ahead of their larger cap brethren? Let's take a look at the key takeaways on the economy in 2025. Recession risk, I think, is lower than it's been in many years, according to many economists. Coming out of the pandemic, we had a brief recession in 2020, and then many investors, many economists, many market players were looking for the economy to continue to deteriorate instead of recover. And so there were lots of calls for recessions in 2021, 22, 23, and those calls have dwindled now as indicators are not pointing at recessions. Still, some investment banks think there's a 25 to 30% chance that we will have a recession in 2026. I'm maintaining my prediction that no recession is on the table. Our economy is so complicated, has so many moving parts, so you can point to any number of indicators as being dovish or hawkish to suit your perspective. But all in all, things are moving along at a reasonable, realistic pace that can be continued for a number of years. And the shifts in the economy that have occurred over the last several decades, as well as the last few years, have created opportunities along with the challenges that they present for consumers and producers. So all in all, I think we're in fine shape from that perspective. Now, there are risks to watch out for. Some of the near-term risks of the economy include issues related to consumption downshifting and sticky inflation. Inflation still remains close to the 3% level that it's leveled out at. We'll look at a chart about this a little bit later, and that could be problematic. Consumption downshifting refers to the trend of consumers who may be getting a little nervous about the overall economy, and so are deferring large purchases or are making do. One example of consumption downshifting occurs in the dining habits of Americans who might be feeling stressed. Instead of going to a sit-down restaurant, they'll opt instead to take the family to a quick service or a fast food restaurant. So in other words, they may still eat out, but they're not going to as fancy a place. And so that trend continues. You might be looking for a car, but you might be looking for a less expensive car than you might have purchased if you were feeling more optimistic about the broad economy, about your personal prospects. The prospect of tariffs, this is very much an open issue, could exacerbate weakness in some sectors. It's hit some sectors pretty hard. The impact of rising prices that tariffs bring with them. So that could continue to be a problem. The K-shaped economy has returned. This is something that we saw in the post-COVID pandemic era, where the well-to-do weren't suffering at all and continued spending apace, while lower income level citizens were holding back, were suffering job layoffs or job insecurity. And so that K-shaped economy as an early indicator of future economic weakness could be something that we'll see more of in 2026. The Treasury spreads, however, do suggest somewhat lower risk than in recent years, as the yield curve is no longer inverted and has more normalized, with longer term bonds paying out higher yields than shorter term bonds. That provides the opportunity for investors to create a more stable bond ladder, for instance, or otherwise manage their safe yielding investments in a better fashion. The AI super cycle that we're in has brought a lot of investment in artificial intelligence throughout. A lot of spending by big companies is primarily, and this has been a concern in the economy because the spending doesn't have an immediate payout, will take some time to earn back results, and this could demand that valuations that are already high might not deliver the returns, or might be threatened if this AI build out that's happening in the AI spending doesn't deliver results. So those are some of the key elements that market watchers are paying attention to right now. Now on the upside, expected tax cuts and real wage gains could bolster the economy significantly. Corporate profits are expected to be strong. We'll talk about estimates for the S&P 500 and market outlook, but they have to be strong in order to support stock valuations. Doesn't leave a lot of wiggle room. If corporate profits come in weaker than expected, that could have a detrimental effect on the market. And in fact, if we see a number of the mega caps and large cap stocks who are underperforming expectations, that could have a trickle down effect on the rest of the market. Unemployment is high. Corporate layoffs that we have seen late in 2025 have been driven more by efficiency restructuring, trying to improve margins, making sure that the business is right-sized for its revenues and earnings and operations, as opposed to companies that are taking emergency action because of economic or operational issues. So that bodes well. Labor market has its areas of weakness, but overall is in an okay place at minimum. And then finally, The tax budget bill that was passed does include some provisions for some federal government spending. The irony is that the party of big business is just really the party of different business. They want to fund different, the Republicans want to fund different elements than Democrats. So the level of spending is still going to be pretty strong as that spending bill kicks into gear and those projects get off the ground for infrastructure spending and other financial incentives out into the market of free capitalism, so to speak. So that could benefit the economy, especially in a midterm election year. Nobody wants to really cut spending, so we would expect that to continue. Now, some of those particular elements, it can be helpful to look at the historical patterns here. Here's a graph of the rate of inflation going back to the 1970s. You can see in the 1980s, inflation regularly exceeded 3% and sometimes was higher than 4%. That inflation rate drifted down in the boom economic years of the 90s as technology continued to drive investment and boost margins. In the 2000s, the inflation rates again started off below the Fed's 2% target at the beginning of the decade after the early recession, and then climbed back up to 3%. The inflation rate was chopped down by the Great Depression of 2008, 2009, and bottomed out below 1% as we entered the 2010s. And then throughout the 2010s, inflation was regularly below the Fed's 2% target, which is a pretty strong indicator of just a nice, evenly growing domestic economy. Inflation upticked significantly, reaching higher than 5% in the aftermath of the pandemic, but quickly came back down as companies figured out their supply chain issues, their supply issues, and we've been seeing that inflation rate starting to drop down closer to 2%, but is still in the last couple of months and in 2025 was trending back up again. At the far end of this graph, you can see that little upturn, and that's that sticky element. The Fed really likes inflation when it's closer to 2%, and so those levels are levels that remain problematic for many economists and market watchers. Corporate profits were strong in 2025. The S&P 500 for the 2025 calendar year was expected to close out the year somewhere between 12.1 and 12.4%. So we'll know as these fourth quarter reports come in the coming weeks if that is actually going to be the case. But if those earnings do come in positively, that would be the 10th consecutive quarter of year-over-year growth in that fourth quarter of 2025. So that's, again, a strong indicator that companies are making money. They're not suffering. Profits are climbing up for the S&P 500, at least, at a sustainable clip. Turning to the labor market, Americans continue to work, and the number of jobs continues to grow. It's flatlined a little bit if you look over on the far right side of the graph in 2025, again rebounding from the post-pandemic year, but that indicates that Americans are working and there are jobs out there that are being filled. Unemployment is pretty low historically. You can compare this going back to the 1950s, wide swings in unemployment depending on whether we're in a recession or expansion of the economy. But those unemployment levels fell back to pre-COVID levels in 21, 22, and since then have been trending up. There's some of this may be baby boomers who are aging out of the market a little bit, who may be close to that age at which they would be no longer considered part of the working class, but there are concerns here about what's driving this unemployment level and why can't this unemployment level get back to a lower level, sustainable below that 4 to 5% range. So it's low, but that uptrend is not something that we want to see. Boy, the housing market really tells a story here, going back to the 1960s. That the number of units of privately owned housing that gets completed, on a regular basis, and of course we see that number peaking in 2008, 2009, right when we see the housing bubble burst and the financial market meltdown and the recession of 2009. We see those the number of new housing units completed dropping way down, and then since 2010 have been slowly rebuilding. There are not enough houses. There's demand for new housing, but right now, one of the primary reasons that this number is on a downtrend, on a little bit of slump there, is because of the costs of mortgages. Mortgage rates are high. That's deterring a lot of homeowners from selling their home and buying a new home because they'd have to refinance it. Mortgage rates that are at least twice, maybe more, like 3 times the rates they were able to secure earlier in the decade. And that is just a hard pill for many home buyers to swallow. So there is demand, but the inventory that's out there, the companies, the home builders are managing to that level, so their comparable year-over-year performance continues to kind of deteriorate just because of the dearth of buyers and their use of incentives to help finance those new home purchases. So something definitely to watch out for. Hopefully, as rates start to come down, mortgage rates would start to come down, and we'd see a little bit more of a pickup on the housing market side. And speaking of mortgages, here's a graph of the 30-year fixed mortgage rates over time. I guarantee if you show this to the current millennial generation and point out that back in the 80s and even into the 90s, mortgages routinely cost more than 10% on a 30-year fixed rate, and they would be shocked. And those rates have come down and down and down, bottoming out just after the pandemic, close to 2.5%. And then as interest rates were raised, those mortgage rates returned to that 7 to 7.5% rate. That's still historically pretty low. Going back to the 90s and to the 2000s, those would be perfectly reasonable rates, but it's just in recent memory since 2010 that those rates now seem very expensive. So there's a perception issue there. There's an affordability issue. There's also a question about how much house you can purchase for your dollars today compared to what you might have spent back in 1982 or 83. And so there's another issue there. Areas of concern, opportunities as well for people who can fix up the and restore or convert office buildings to residential apartments, multi-home apartment builders. There seems to be opportunities there as these mortgage rates remain at that high level and kind of, again, stuck and stubborn a little bit, but hopefully as we get some interest rate relief, those rates would decline. And then to wrap it all up, we have consumer sentiment, and it's hard to make sense of this with all of the positives about the economy. Americans are working. The inflation has been coming down, and yet consumer sentiment is sinking, continues to drop. It's very close to a 25-year low, according to the University of Michigan Consumer Sentiment Survey. And obviously, leading up to the pandemic, sentiment was very positive as the economy was growing, the market was performing. During the pandemic, sentiment declined. Of course, lots of uncertainty was introduced, recovered a little bit, but then since then has just been dropping down to very low levels, and recently in 2025 again is just continuing to be quite low. So there is a disconnect here between what consumers say and what consumers do. So they say that they're concerned, but yet they're spending as if it's no problem, that they're not worried about their jobs. They're doing some downshifting, as we talked about, in consumption, but all in all, there's not enough of that going on to correlate to the level of consumer sentiment that they express when they're asked, how are you feeling about the economy, and what's your outlook? Those appear to be quite negative. I think there's a huge overlay of media that's driving individual dissatisfaction, regardless of the realities of business and people who have jobs and who are working, and communities that are, wholesome and happy, and where people are living comfortable lives. There's always going to be a strata of lower income people who need, might need support, but all in all, as a country, uh, everything about the market and the economy has been pretty strong, but yet individuals are saying they're concerned, and yet the market's at all-time highs in terms of stocks and valuations. So a lot of disparities here, and I think this is one of the key contributors to it feeds on itself, and it creates more disarray in terms of perspectives about the market and the economy. I wanted to talk about the 2025 stock market now, and what are some of my key takeaways. I like to look at this graph of the S&P 500 PE ratios going all the way back to 1870. Of course, that's a different time entirely, but even here we can see how the market reacted during periods of turmoil, global wars, periods of economic expansion and contraction. But over there on the far right, the PE has been climbing in 2025 and is now at 31.35, which is a extremely high PE relative to the history. Prior to 1998, the market never reached this valuation level. After 1998, as we hit the 2000 boom, you can see some spikes there as valuations increased during the recessions and bear markets of the early 2000s and the early and the late 2000s until we got up to 2010. Another spike for the pandemic in 2020. I think those are outliers, but we're not in an outlier situation right now with respect to the market and the economy. We are just in a period of extended high valuation. Is that overvaluation? That could be. Is it hypervaluation? Perhaps that is a very, very rich valuation, to be sure. And the one thing about a high PE ratio valuation is that it demands support from the underlying businesses. In other words, companies need to deliver earnings in order to justify those valuations, and that, I think, increases risk. But on the other hand, the companies are well equipped at this point to be able to deliver the growth that satisfies that. I would love to see those PE ratios pause for a little bit instead of continuing to grow. I would love to see the attention be turned to the small caps as well. But in terms of the large cap market, it's a very rich valuation and definitely something to watch out for, but it is justified by expectations that do not seem unreasonable for growth in 2026. Now, when we look at the P ratio since 2015, you can see that the PE ratio remains higher than any period except during that COVID era market valuation, where a lot of company earnings declined, but investors didn't respond by pulling all the money out of the market. We didn't see a massive correction that lasted very long, so that boosted the PE ratios there. But it still remains a much higher PE ratio when you look at that 2015 to 2020, where PE ratios range between 20 to 25. That seems very defensible. And then after the pandemic, after the valuations and companies sort of found their footing again, we saw that slow creep up of PE ratios back to that 31 level, which is pretty high. The case for why PEs are so high, in part, it can be discerned on this graph of the historical earnings per share of the S&P 500 in totality, reaching very close to a near peak. We saw a little bit of peak post-pandemic. You see earnings go up, they go down. They're pretty volatile over time. For the S&P 500, they drop off during periods of economic distress, like the COVID pandemic or the Great Depression. But all in all, this growing graph of earnings gives support for the bulls who say, yeah, the market's pricey, but it's justifiable because of the success of the underlying businesses. If we look at the 10-year Treasury rate, it peaked around 4.79%, and that's the high from 12 months ago. And it still is above 4%. And you can see the trend since the mid-'80s, where that 10-year Treasury, at one point was yielding 15%. It's come back down, bottomed out below 1% post-pandemic, and how it's crept back up to that 4% level. Now, at 4%, 4.2%, that's not enough to tempt investors out of the market into fixed income. And so that is another plank in the platform that says, if we stick around in stocks, we're going to get the best return. There's no point in building out a portfolio that includes a heaping allocation of bonds. You might do it to reduce a little bit of the volatility, but if you can stomach the volatility, you can probably maintain an all-stock portfolio with some defensive exposure and not have to worry about treasuries. Given the history of the market in the last couple of decades, it's going to take yields a lot higher than this to tempt people away from equities. That's another case for the bulls, where the market will continue. If the market continues to perform, it's going to keep people in the market. Dividends are another case. You can see the graph here of the history of the yield of the S&P 500, and those yields continue to slow. The yield of the S&P 500 now, this is a function of the price to one extent. As the price goes up, the yield goes down without a change in the underlying dividend payments. But yields now, the S&P 500 at 1.13%. Companies are not using their capital to reward shareholders with cash dividends. Instead, they're buying back shares, they're reinvesting for growth, they're looking for acquisitions, they're paying down debt. They're doing everything except paying dividends. And you can watch one of the webinars I did last year for Better Investing in the American Association of Individual Investors about what's new about dividends and why you can't rely on the old patterns of looking for dividend companies paying 4% yields. There are fewer and fewer of them, and the big blue chips are not paying out as much of their profits as they had been in the 60s and 70s, as they had been in the 30s, 40s, and 50s. And so if you are a dividend investor, you want to pay attention to this and understand the dynamics of capital usage amongst these blue chip large cap stocks. Here's a graph of the S&P 500 forecast from the major investment banks for the calendar year 2026. All of them are positive. Stifel published a range between 6,500 and 7,500. The S&P 500 closed at 6,845 at the end of the year. The average of these major investment banks is a gain of the S&P 500 to 7574, the median to 7700. Oppenheimer, the most optimistic, expecting the S&P 500 to hit 8100. Deutsche Bank sees the S&P 500 reaching 8,000. So there's a lot of optimism built into the market, including some of the former bears rather. Bank of America, the lowest after Stifel, seeing a gain of just a little bit to 7,100, definitely playing it safe. But some of the other major banks, Morgan Stanley, Citi, UBS, JP Morgan, all expecting a positive year for stocks. And that's something to keep in mind. On the one hand, if you're contrarian, maybe this gives you pause. If everyone is expecting such good things, maybe there's a case to be made for the unexpected. And as we like to say, bear markets don't send out invitations, so it pays to be defensive throughout your investing career and to expect the unexpected. If the expectation is the market's going to have another robust year in 2026, being prepared for a downturn might be a very wise move. So why did these investment banks and other investors see a positive case for large caps in 2026? Well, there are a couple of key themes that you can point to. Certainly the Tax Reconciliation Act that's going into effect will deliver some tailwinds in the form of reduction in corporate taxes and investment incentives, and some other provisions that could boost large company performance. Increased AI adoption. The trend now, AI is moving out from building out the infrastructure to delivering real gains in productivity. In other words, a lot of AI has been deployed for entertainment purposes, I'll say, where there's not a firm hand on how it can be deployed widely. Some companies report much success in deploying AI to support customer service applications and other operations of their businesses, but there's still plenty of room if we believe the AI bulls. There's plenty of opportunities for companies to be deploying and to see benefits from artificial intelligence. With analysts seeing as much as 15% earnings growth for the S&P 500 in 2026, that's double the long-term historical average. Margins are at record levels. So that is certainly something that you can point to in a very tangible way and track on a quarter-to-quarter basis to see if the year will continue to perform as it has in 2025. The bulls expect a soft landing for the Fed, that the Fed can ease this, end this easing cycle without triggering inflation. In those rate cuts, lowering cost of capital, which will enable companies to build out, to improve and upgrade, enhance, acquire other businesses, etc. The lower rates are also helping with mergers and acquisitions in the corporate world. So low rates and the underwhelming valuations of many small companies should help boost mergers and acquisitions volume. We start to see a little bit of that in 2025. In fact, 3 of the covered companies in the small cap informer were acquired this year. I would expect that more of the companies we cover would be attractive to purchasers. They're high quality businesses. They don't come with a lot of luggage, and yet they are undervalued compared to larger peers and would seem to be quite desirable acquisition candidates. And then finally, sector rotation could help boost results. Utilities are performing well under expectations, as well as active deployments for AI buildouts. These AI data centers demand a lot of power. So that's actually boosted utility stocks in the end of 2025, as well as financial stocks with lower interest rates leading to higher loan demand. So that's increasing the margins of some, especially small regional banks. And so those returns from those 2 sectors have helped boost and kind of prop up the overall performance in 2025, and that those trends would definitely continue in 2026 given the visibility we have right now. On the flip side, the bear case for large caps in 2026 revolves around issues like sticky inflation, right? Tariff costs have been absorbed in 2025 largely by companies. instead of passing it along to consumers in the form of rising prices. Will that continue as costs continue to be high? Will that impact those companies' policies? Are they going to get tired of it and say, yeah, that's right, now we've been absorbing those costs, and now we're going to start raising prices in order to compensate. The labor market, definitely something to be watched. With unemployment on this upward trend, the bears have a case for this as an indicator of potential concern about the broader business environment. The valuation extremes of the mega caps and the large caps, this artificial intelligence capital expenditures, and the lag of realizing the revenue gains from those build outs could impede the performance of stocks. And so what I mean is that it takes, you're investing billions and billions of dollars into building out facilities and capacity to accommodate artificial intelligence. The revenue gains don't come immediately. They're going to come over time. And so that lag there in between could be problematic for some investors who want immediacy in the returns and are not patient to sit around. And so a few of those large companies start to sell off because of disappointments, because they're not moving fast enough, and that will trickle down into mid-sized and small company stocks. And then finally, we are in a midterm election year, so we've got geopolitical and policy shocks on top of all of the turmoil that we've already seen with government shutdowns and tariffs. And now the new conflict between the presidential administration and the Fed and Jerome Powell. That could discourage investors if the independence of the Fed is wiped out. Then that would likely lead to inflation because we'd see interest rates that would get slashed. That would contribute to an inflationary environment, and so we're back into the throes of economic turmoil. And so that's something that the bears are definitely pointing to as a reason to consider 2026 from a cautionary perspective. On the small cap side, many of the same elements are applicable, but the small caps might feel some of these issues more deeply, as well as be impacted at different points in the business cycle than their larger brethren. One of these is the higher for even longer trap, that slower rate reduction could delay small cap recovery. So small caps, again, highly dependent on capital in many cases. When capital is expensive, it makes it more difficult for them to see the results that they're aiming for. Sticky inflation continues at this level. If it just can't get brought down closer to that 2% target, that impacts the schedule of rate reductions, and that would have an adverse effect on smaller company stocks to a greater degree than larger company stocks. The debt refinancing cliff, many small company stocks, they rely on short-term and floating rate debt in many cases. So a lot of smaller companies took advantage of ultra low interest rates, in 2021, 2022, but for short-term periods. And now, if they need to refinance those, they're going to have to be doing it at 5, 6, 7% instead of 2 or 3%. And so that could increase costs, increase interest expense, and would have an impact on the balance sheets of smaller companies. As we are still navigating tariffs, there is a whiplash effect that bears are pointing to. Let's say small caps have already been benefiting from onshoring and domestic production moves, but on the supply side, if their suppliers are not of the goods and services they utilize are not able to accommodate the new tariff and domestic trade policies, then we might start to see smaller companies suffering. it's amazing how well the companies that we track in the small cap informer have performed because of our emphasis on quality and manageable debt levels. We haven't seen this whiplash effect, but other small companies could well see that in 2026. The K-shaped consumer and consumer spending patterns and the labor slowdown could impact small company stocks to a greater degree as consumers downshift their consumption, as they reel in spending a little bit. That those types of trends tend to impact smaller companies more severely. The pressure on the lower income population still remains, and we've seen companies like Dollar General and Walmart pointing to strapped customers. That they're seeing perhaps some upticks in revenues at a certain level as people swap shopping at a regular, grocery store in favor of the perceived savings they get from a big discount retailer or a store like Dollar General. And so it's been a mixed bag for those businesses, but there is a lower strata from an income perspective of the U.S. population that's feeling things more than the middle income and high net worth individuals, and so that's something to watch over time. And then the fragility of the labor market. Jobs are going up. Unemployment is also increasing. Smaller companies, or all companies, are having trouble finding staff, especially at entry-level positions, and so those labor issues could impact smaller companies, and that's something that could trigger some kickbacks in the small company operations realm in 2026. And then we flip over to the bull case for small caps. Earnings strength for the small caps is actually higher right now, looking at 2026, than for large caps. So there's a lot of optimism built into the lower valued small cap stocks for higher results in 2026. And if that is the case, it's hard to imagine that some capital won't be pulled out of the stagnant large cap market and put into smaller companies. This historic valuation gap, we'll look at the PE ratios of the S&P 600 compared to the S&P 500 in just a bit, but that means historically, when we have these big gaps between small and large reaching extremes, the capital rotates. There is a perception from investors that mega caps are a little frothy or a little overextended or hypervalued, they might pull some of that capital in, and it's hard to ignore a bargain, right? And so many small company stocks are offering bargains at their current valuations. The big beneficiaries of artificial intelligence so far have been large caps, and that will continue to trickle down into the mid-size and small company stocks. And so if those small company stocks start embracing AI and see productivity and efficiency gains, that could have a positive net impact on their margins. And then, as we mentioned, the mergers and acquisitions activity, more IPOs and buyouts will tend to benefit smaller companies. And so if we expect that as rates go down, corporate buyouts increase, then we would expect some of those well-managed small companies to get swept up in those types of acquisitions. Here is that graph of the PE ratio of the S&P 500 compared to the S&P 600. This is as of the beginning of the year, 2026, using trailing estimates for the S&P 500, or trailing 12-month earnings for the S&P 500, 27.94, compared to the small cap 600 at 18.18. And this is where the dichotomy between small and large cap valuations really comes to play. If indeed small caps have a higher earnings potential for 2026 than the S&P 500 companies do, as is the case right now, that valuation, that PE ratio of small caps on average would appear to be screaming, buy me, buy me, buy me. So I contend that this is another indicator of the undervaluation of small cap stocks. So no matter what happens in the market, maintain your plan, stay the course. Remember, the companies that grow their earnings over time will see their share prices grow over time. And in the short term, anything could happen. And we would expect, you should expect that anything could happen in 2026, and that things that we don't expect will happen in 2026, for sometimes for the better, and sometimes for the worse. Focusing on high quality companies relative to peers is a great way to help mitigate some of the downside risks of the stock market. Don't buy trends and fads, FOMO, YOLO stocks. Stick to your long-term approach. And if you are jumping into more speculative companies, make sure you have a plan to mitigate the volatility. Do you have stops in place? Do you have an exit strategy? And always be prepared for market reversals. Bear markets never send out invitations, so don't be surprised when they show up on your doorstep. So if you have any questions, let me know. I see Tim asks, do I have any idea about where the capital is coming from that's moving into small company stocks? And so far, we haven't seen that that trend in place. So I would expect it as the valuation extremes continue, and history says that the returns regress to the mean, and so this period of overvalued large company stocks will end. We would hope that would end on have a soft landing, and not a fast correction and a lengthy bear market. But so far, investors are still, by and large, staying away from small company stocks. And I think that gives us an opportunity for patient investors to find those opportunities and hold on to them for the longer term. And now let's take a look at my picks for 2026 from the SmallCap Informer stock universe. These are a handful of companies that I think deserve a little extra attention as we start the year. You can download the whole special report from the subscribers area of the SmallCap Informer's website. These are those companies that I think represent the best opportunity for total return in the calendar year selected from the current coverage. The focus is always on the long-term performance, but I think our top stock selections give you a chance to reconsider stocks that we've covered in the past that may merit consideration for your portfolio because of the attractive reward to risk potential that they present at their current valuations and fundamental trends. There are 5 companies here that we've pulled from the list. Many of these have been focus stocks in 2025. A couple of them we recommended in 2024. So you can see the PE ratios range from 9 for a real estate investment trust up to 20 and 24 for some of the healthcare and financial holdings. They're all delivering reasonable earnings growth and attractive total return, and a couple of them even have some yield potential. My first stock is Palomar Holdings. This is a property and casualty insurer. They operate in 5 categories, including earthquake, inland marine, casualty, fronting, and crop insurance. They are the leading earthquake insurer in the United States. They operate a fronting business where they issue insurance policies on behalf of self-insured organizations or captive insurers where they don't assume the transfer of risk. They also operate in areas like Texas and Florida where they have been actively reducing their exposure because of the increased risks regarding weather events in those states. They previously were operating in Hawaii and offered hurricane insurance there. They have also, as many insurers, pulled out of the state because of the great risks of hurricanes in the Hawaiian Islands. Palomar is part of a consortium that was put together to share the risk amongst several insurers. But Palomar is not one of those actual insurers. They administer the program. So in other words, they have the ability to earn revenue without the risk of paying out claims. And so there's so much that we like to see about this particular property and casualty insurer. Their margins are excellent. One of the property and casualty insurers that Better Investing members or subscribers to our sister newsletter, the Investor Advisory Service, might be aware of is Kinsale Capital Group, slightly higher margins, but I think a greater risk potential because of their property and casualty portfolio. But Palomar and the handful of high margin property and casualty insurance companies are way above the averages of that industry group. That's a very troubled industry group, but Palomar's balance sheet is strong. Their investment portfolio is very robust. And look at this graph. This is just a great trajectory of sales in green at the top and blue earnings on the bottom. Prices midway between the 52-week high and low. It's performed well for us since in the last year was up about 30%, but I think there's plenty of potential for the stock moving forward. Now, Harmony Biosciences is a biotech. We cover a couple of biotechs. We don't cover the speculative research businesses. We cover commercial stage offerers of biotechnology and pharmaceuticals. So Harmony, again, has been profitable for several years now. They focus on some fringe, afflictions and diseases. Their focus is on rare neurological disorders, including narcolepsy and hypersomnia, as well as epilepsy and some related neurobehavioral afflictions. So I see this business as being a good cash generator. They have a super strong balance sheet. They've got patent expirations that could go out as long as 2044, which is good. The debt is downtrending. They're always in the market for acquisitions that would boost their product lineup and take products to market and start generating revenues and earnings. I think their trend is pretty strong here. They've come down since we recommended them in price quite a bit, despite fundamental strength. And so I think in the defensive healthcare sector, this is a stock that you might want to consider at its current valuation. Another healthcare stock that we like quite a bit is Addus Home Care. This is a provider of in-home nursing and hospice services. Again, the trajectory of growth has been very strong. They operate across the country, but their strongholds are in Texas and Illinois. I think the bear case for Addus is, in a business that's committed to serving Medicare, Medicaid patients. Is it wise to be investing in them when funding for Medicare and Medicaid could be at risk? But on the flip side, the bull case says insurers, health insurance companies, love companies like Addus because home care is a fraction of the cost of hospital care, institutional care. So if you can get people home, people want to be at home to recover. If you can get them at home and serve them with home health aides and home services, the patients like it, they get a better outcome. Insurers like it because it reduces their costs. It doesn't cost as much to use home care. And so for that reason, I think Addus is in a pretty protected space. The other advantage they have over similar companies is they are a low-cost provider. And so if they have to increase costs a little bit, they can still be competitive despite reimbursement rates being what they may. And so that positions them quite well, I think, for their particular business. Again, in the home healthcare and the broader healthcare industry, I think this is a really interesting, solid performer. Now, Alpine Income Properties is a real estate investment trust. This means it has to pay out the bulk of its earnings every year to shareholders. So as a result, the yield is currently about 6.7%. Though it is a small business, it's probably one of the smallest publicly traded REITs. It does operate a portfolio of 128 tenants in 34 states. They are all triple net leases, which means that Alpine owns the land and the building, but companies are responsible for the taxes, for the improvements, for the operations, for the maintenance. And so it's a very reasonable business model. The tenants like it because they don't have to actually buy property. They just sign a lease. If they need improvements or expansions to the building, they renegotiate the lease. Alpine would build out the new addition, and then the lease payments would cover that would be higher to cover those costs. So it's a functional way for a lot of retail businesses to operate. The top 10 tenants, you probably know most of these companies: Lowe's, Dick's Sporting Goods, Walgreens, Best Buy, Family Dollar, Dollar General, Walmart, and At Home are in the top 10. They also have Academy Sports and Alamo Drafthouse as tenants. The lease expirations are good, in a good place. The balance sheet is strong. Now, they have been focusing in the last couple of years on something called asset recycling. They're trying to make sure that the balance of their tenants that are high quality versus low quality is at that right point, right split. So high quality tenants, investment grade tenants, usually are very desirable because you don't have to worry about them defaulting on or not missing rent payments. They're good businesses. Companies like Lowe's, companies like Walmart. No one who's a landlord is really worried that they're going to be missing rent payments, right? On the other side, you've got small sub-investment grade retail businesses that want space, don't have a long track record, don't have the financial stability. So as a result, they're willing to pay higher rents. So if you own a building, higher rents can be desirable, but it has to offset the risk that those tenants will go out of business, they'll shut down their stores, they'll stop paying rent, they'll run out of money. So Alpine has been improving its portfolio in a very real way to achieve that optimal balance. And I think they've been pretty successful. They've also started making commercial mortgage and construction loans using their expertise to make loans with rates between 8 and 12.5%. So again, another strong use of their capital that allows them to deliver profits. And I think this is really one of the unsung heroes of the real estate investment trust business. Walgreens was one of their top tenants, but given Walgreens' financial difficulties of the last few years, they have been winding down and getting rid of those Walgreens properties and then investing in higher grade properties. Yield, as I said, 6.7% right now, so very attractive. I think this is one of those buy and hold stocks that you can gain current income as well as the potential for capital appreciation over time. Just stay away from REITs in an investment club for the most part. And then finally, Carrot Packaging. Went public in 2021. It's been around much longer than that. This is a distributor and manufacturer of environmentally friendly disposable food service products and related items. So all the sorts of packaging that you get. And I'm interested in this company because of the real trend in the US of takeout food and food delivery. Uber Eats, DoorDash, etc. And those are demanding different types of packaging. If you've ever, walked into a Dunkin' Donuts and seen the stream of DoorDash and Uber Eats delivery people coming in to pick up deliveries, you'll see the packaging systems that have been built expressly for that purchase, where the drinks are in a cardboard divider that's not going to tip over. The bags are sealed. Everything has got a place inside the bag so that it doesn't, the heavier items don't crush the lighter items. And then the delivery person picks it up and at no point in that process from leaving the restaurant is that bag open. It's been sealed shut. And that all requires new packaging. And I think Carrot and the services they provide feed into those trends in a very real way that's going to help the business grow over time. The customers that use their packaging include Chipotle's, Chili's, Sonic, In-N-Out Burger, Dutch Brothers, Texas Roadhouse, Panda Express, El Pollo Loco, Applebee's, Darden Restaurants. All right, so this is a number of major chains that are utilizing Carrot products. But interestingly, they also, as a manufacturer, their products are carried by other distributors like Cisco, US Foods, Shamrock Foods, right, who are manufacturing and distributing their own goods. So it's very interesting when a business is able to count as customers their competitors, right? And so I think that also is one of the elements that I liked about this particular business. And finally, in 2025, they were adding a pilot program for grocery stores. Again, grocery stores use a lot of packaging, from the salad bars and deli counters to the checkout lanes. And so there are a lot of opportunities there to be the preferred provider for some of these large national grocery store chains that would really drive the business. The current yield is about 7%. So this is kind of an interesting yield growth play on the small cap side that I think has a lot of potential moving forward. So finally, we'll wrap it up with a review of last year's picks. You win some, you lose some last year. Two of our 5 picks performed quite well. 3 of them underperformed. Mtron Industries up 10% for the year. Since this year has gone on to eke out some more gains. Palomar Holdings was up to 32% for the year. That's our big winner. On the loser side, Interparfums and Lantheus Holdings were down 29%. 30%, while Intest was down 10%. Intest is in the semiconductor area. They're a very tiny business, so small gains in the fundamentals don't warrant big jumps in their prices. But I believe as the semiconductor cycle matures, that their prospects still remain pretty good at their undervalued levels. Interparfums, the high net worth consumer fragrance business, got hammered by tariffs and the global nature of their business. They've been working on increasing domestic production in the United States. There are risks around expiration of deals they have with different brands that could impact them. And then Lantheus Holdings, probably the wrong time at the beginning of last year to invest in this biotech, down 30% for the year, probably at a more attractive rate right now. All in all, those picks are up on average of 4.3%, or up, we're down an average of 6% compared to 4.3% for the S&P 600. So not the best year for last year's selections, but we'll see how this year's top stock picks work out for our subscribers. So with that, I want to thank you for being a subscriber to our Small Cap Informer newsletter. We are entering our 14th year, and so we want to continue to deliver the results that hopefully you will expect. Thanks to Bob in the comments, who said his portfolio gained beat the S&P 500 last year because of the Small Cap Informer picks that he added to his portfolio. We appreciate that. We hope that you all continue to be able to find the use of our small cap picks to help you flesh out your portfolio objectives and find those smaller companies that will deliver results over the longer term. I look forward to your feedback, so please feel free to email me with suggestions and questions throughout the year. And I wish you all the best for 2026 and beyond. And until next time, I'm Doug Gerlach. Thanks again.